In the realm of global capital flows, the tides are shifting, with new currents of investment traversing once uncharted waters. At the vanguard of this financial flux is an unlikely pairing, Saudi Arabia, that prodigious petro-kingdom of dunes and dates, and Brazil, the verdant colossus astride the bulging waistline of South America. Until recently, the connections between these two distant lands were tenuous at best. Saudi investment in Brazil was so meager that it didn't even merit a line on the central bank's ledger of foreign influxes. But in the span of just 3 years, that trickle has morphed into a torrent, with Saudi capital commitments to Brazil swelling sevenfold to an impressive $4 billion. And this, it seems, is merely the Flatide's first undulating crest. That figure should keep growing, avows Abdulrahman Bakir, the Saudi Investment Ministry's impresario for the Americas, a man whose mission is to midwife ever more eddies of monetary exchange between these far-flung nations. It is an ambition born of enlightened pragmatism, for while cultural chasms may yawn between the Saudi realms of Sunni Islam and the syncretistic fiestas of Brazil's Catholicism, their economies are increasingly codependent passengers aboard the ark of 21st-century globaloney. For Saudi Arabia, still heavily reliant on the grim eminence of its fossil fuel reserves, Brazil's lushly diversified agro-industries, from soybeans to sugarcane, offer an annuity of sustainable growth. For Brazil, mired in the muddled realpolitik of Latin American volatility, and eternally craving foreign direct investment, Saudi capital presents a rejuvenating elixir. So it was that last year, Bakir orchestrated a veritable money changers armada to descend upon South America. 100 Saudi officials, investors, and movers and shakers, many representing those opulently cosseted family offices that increasingly dominate global capital flows, fanned out across 7 Latin nations in a tightly choreographed 10-day tour de force. The opening baritone salvo of that investment opera? A rousing $3.5 billion in promised expenditures across a portfolio of memorandums. But this was merely the overture, a herald of more sumptuous finance to come. Think about it as an umbrella of investors, intones Bakir with the aria of the initiate, citing a litany of backers from Saudi sovereign wealth to family fiefdoms. We're trying to really emphasize a lot now in family offices. It is a song Bakir has been warbling directly into the ears of the Saudi Investment Ministry's lead maestro, Minister Khalid Al-Falih. Since decamping to his Washington-based role, Bakir has lobbied relentlessly to broaden Saudi capital's diversifications beyond the kingdom's long-standing U.S. arcs of interest. The U.S. relationship is very important. It's been there for ages, the strongest ally for Saudi, Bakir rightly notes in a tone of deferential acknowledgement. But what about South America? That plaintive query has yielded fertile new overtures. From the cosmopolitan claves of São Paulo to the austere chorus lines of Riyadh, a series of harmonious investor conclaves have convened. Even the hallowed precincts of Los Angeles's Milken Institute and Davos' vaunted Alphorns have resounded with the refrains of grander Saudi-Brazilian business alignments. As but one example of this new co-production, the Saudi Sovereign Wealth Fund has channeled some $400 million in direct investment to funds overseen by Patria, Brazil's venerable asset manager. Elsewhere in the dramatis personae, the Saudi firm Manara Minerals has expended a cool $2.6 billion to purchase a controlling stake in the base metals unit of Brazil's mining behemoth Vale. Meanwhile, Saudi Arabia's agricultural investment company, SALIC, has acquired significant stakes in the Brazilian food purveyors, Minerva and BRF. It is an overture of financiers dancing in arabesques, with ever more improbable pas de deux being choreographed. For beyond traditional spheres like mining and energy, Saudi investors are now eyeing a smorgasbord of Brazilian investment opportunities in realms as diverse as food, medical technology, pharmaceuticals, cosmetics, tourism, and even petrochemicals. It's a burgeoning spirit of entrepreneurial integration that flows both ways. Just as Saudi capital is angling to partake of Brazil's bounties, Bakir notes concerted efforts to lure Brazilian companies to establish production facilities and regional outposts within the kingdom itself. All of which hints at an evolving symbiosis, a tango of mutual commercial integration animated by the durable insight that scarcity in one realm can be ameliorated by the abundance found in another. As Bakir observes with the bemused bemusement of a seasoned impresario, Latin America is one of the few regions where you have more opportunities than capital. In the Middle East, it's the opposite. Thus is the stage set for a beautiful pas de deux, with Brazilian enterprises granted access to the deep capital reservoirs of the Saudi moneymen, and their free-spending brethren in turn availed of attractive new investment apertures in the New World's fertile topographies of potentiality. So if you come at the sweet spot, Bakir concludes with the air of a master theoremist, your returns can be much, much higher. It is a duet of prosperities, being composed in tones of sincerity and enlightened self-interest, with both nations striving to intertwine their assets for enriched future harmonies. And yet, for all their soaring ambitions, challenges still encumber the maestros of this budding symphony, like droning percussionists intent on disrupting the arias. Chief among them are the customary hurdles inherent to long-distance economic intimate ties, the migrainous complexities of binational regulatory regimes, the languors of bureaucratic lassitude, and the omnipresent quest to grease the connections between each nation's private sectors, so capital may course unimpeded. These are the inevitable consequences of spanning such vast distances, geographic and cultural, in pursuit of that most sanctified of unions, the multilateral marriage of money. But if the augurs are accurate, these inevitable frictions between unlikely bedmates are more than offset by the prodigious profits to be reaped from their commingled rapprochement. For beyond mere dollars and reals, what seems to be catalyzing here is a borderless renaissance of enterprise, a celebration of human ingenuity unbound by pesky delineations of ethnicity or creed. Bit by bit, deal by deal, memorandum by memorandum, the once implacable barriers are softening, metamorphosing into ley lines of connectivity along which enrichment and understanding will surely follow. It is as if the very tectonic plates of global integration are shifting anew, forging unforeseen pathways for wealth to permeate. And at this embryonic juncture, two distinctly disparate nations have volunteered to serve as the avant-garde, the shock troops in a quiet revolution dedicated to the perpetual reappraisal of just who can gain from cooperating with whom on this swirling, interdependent planet of ours. For in 2023, even a once unimaginable tango between the Islamic kingdom and the Samba nation is not just possible, but perhaps even portended. The capitalists seek new partners in unaccustomed places, and the Earth's fertile latitudes grow slightly more verdant from their fructifying exertions. May this burgeoning bond of bilateral beneficence augur well for all of humanity's integrating futures. Through financial harmonies, authentic human understandings may well be catalyzed in regions once insensible to each other's siren songs. So it has ever been with that most noble of human striving, the primal quest for increasing economic interdependence. Today's strange new bedfellows may seed tomorrow's planetary consciousness. The dance continues, one arduously choreographed step at a time.